Good afternoon, everybody, and welcome to the Midday Market Update on October 27th on this beautiful Tuesday here from Chattanooga, Tennessee at Freight Alley. With me today is Andrew Cox. Andrew, how you doing today, my friend?
I am lovely, Mike. Thanks for having me. Sitting in for Mr. Kevin Hill. He's still coming back on vacation. Be back tomorrow, though.
He's been on vacation a while, hasn't he?
I know. He's been kicking it up. He's been working hard, though, this entire first half of the year. I know in my boss, he's been doing all kinds of shows, so he deserves the time off.
Yeah, he certainly does.
He went for some nice weather, and he's told me he's had terrible weather there in Tulsa. He called me yesterday. Right? It was like 33 degrees and sleeting, so he's excited to get back to the 70-degree weather we have here.
Yeah, not doing much golfing out there in Tulsa these days, right?
Not today.
Not much. Hey, we got a great show for everybody today. We got Chris Richter, the founder and CEO at FloorFound, who's going to be on talking about white glove home delivery and reverse logistics and a technology play there, which is going to be really interesting. We've got Laurence Alvarado, who is co-founder and CEO at WARECAP, flexible space warehousing and I believe parking as well. He's in a cold chain, and we'll talk about the warehousing situation right now, moving through the fourth quarter and possible vaccines, that type of stuff. We've also got weather with Nick Austin and freight markets with Zach Strickland, economic update with Anthony Smith, and Andrew and I will be doing the news, which we'll toss it to ourselves for the news, and we'll do that right after we thank our sponsors here, Amazon Freight. Freight moves fast, and you need a shipping partner that can handle what's in front of you while also planning for the future. Amazon Freight has opened up their network to enable shippers of all sizes and the ability to simplify, optimize, and invent. Tap into the expertise of Amazon with a freight partner that is here to help you navigate the road ahead. Discover what's next at freight.amazon.com immediately after the show.
Yeah, so we'll jump over to our first news story. This definitely benefits Amazon and Amazon Freight. This is a story that came out of DHL Express. They are expecting a huge holiday season for e-commerce especially. So on Monday, DHL Express said that it expects e-commerce shipments to grow more than 50% over last year's peak leading up into the holidays. They expect a similar spike in inbound volumes into the Americas. They also said that already in its network, e-commerce volumes are up 35% this year over 2019 and predicted that online sales will increase further with the popular blowout shopping days like Black Friday and Cyber Monday.
So 35%, is that the trend so far this year overall, or is that like recent because of the pull forward that we saw happen?
I think this is smoothed out of the entire year, or currently, I'd say probably currently year over year, running up 35%. They're expecting it to go up even further with these big holidays.
Yeah, sure, I would imagine
big holidays up. And then I got some more data for you. eMarketer here, which is a data analysis platform, they forecast that U.S. e-commerce sales are going to jump 36% to nearly $200 billion during this holiday season, while brick and mortar retail will decline roughly 5% to about $820 billion. They expect the Cyber Monday sales to increase 38% to about $13 billion, and they expect the total percentage of retail sales on e-commerce to jump from 15.9 to about 19%. So big jump there. But they're not the only. There are some people that feel the opposite way. There's some people that don't think this shopping season is going to be quite as rosy as DHL. I'll give a plug here to Seth Holm and I. We're going to be talking about this on the Great Quarter Guys at 2 p.m. today. We've got a call from a UBS analyst named Jay Soul, who is kind of expecting there's going to be this massive pull forward in retail, especially e-commerce. So that he's expecting things post December 1st, post Black Friday to be kind of weak. He's thinking that a lot of the shopping will get done before the December holiday, before the December comes, and he's got some basis here, right? So if you look at consumer confidence, it really has worked inversely of COVID cases. As COVID cases have gone up, consumer confidence has come down. The consumer confidence peaks have been in the same months as the valleys for the coronavirus. And we see coronavirus cases is surging now, could get worse into December, so he does have some basis there.
Yeah, he certainly does. And I would think also besides that is the pull forward, right, is going to kind of pull that shopping forward. So he's looking at it being pretty rosy right now, but then tapering off after Black Friday and December 1st. And people, you got the consumers that are already used to and a little bit concerned about the cycle times, the lead times for ordering and getting it to you, right? So the closer it gets, you can't go shopping on the 24th anymore, Andrew, not this year.
No, not even Amazon, the ones that have set it straight with these 2-day deliveries are not going to be able to fulfill that so much this year.
But DHL Express said it's prepared for the surge in volume thanks to regular investments of about $1 billion per year in its network. So for 2020, it has hired more than 10,000 permanent employees, including 3,000 in the U.S. DHL has increased daily cargo flights also this year to handle the extra demand for e-commerce and obviously the COVID medical supplies, all the PPE, partially elevating ongoing transport shortages associated with the grounding of passenger flights, which it just hit a mile mark again?
Yeah, so Kevin and I have been watching this pretty closely. Just for the first time since March, we saw that daily passengers for TSA checkpoints reached 1 million, which is about half of the normal throughput. So we're still way below 2019 or historical averages.
Somewhere around 50%, which would be
well, they're not averaging there, but they hit that number for the first time.
I got you.
So we're still not expecting them to even reach or average 50%. Maybe around the holidays they might, but again, still a lot of passenger flights that are grounded right now, and just the demand is still relatively really weak.
Yeah, absolutely. And talking to Brian Schreiber, who's he runs Rickenbacker up in Columbus, Ohio. Sorry about that. OH, everybody, to correct my mistake. He's talking about, they just did Korean Air, and they're getting plenty of flights inside there where the seats from the upper deck have been removed, and they're bringing in cargo there. So the airlines are responding to this and moving more cargo. They're not expecting it to come back to 100% anytime soon, I wouldn't think.
Sure, they're definitely expecting a good holiday season, making space for it here. Somebody else who's had a great season, Old Dominion, my goodness, set a new record with their operating ratio. So LTL carrier Old Dominion set a new company operating ratio record in the third quarter 2020, posting a 74.5 operating ratio. So for anybody outside of the industry that hasn't heard this term, the operating ratio are your total operating expenses as a percentage of net sales. So for example, ODFL, 74.5% of their net sales went to operating expenses, which is unbelievable. Mike, you've been in this industry a lot longer than I have. In your past at logistics providers, what would be a desirable OR you guys were going for?
Yeah, so back in the day, we would pop champagne corks at about a 92.5 or a 90, and if we certainly got into the 80s, it was a big day. It was a good month, a good quarter. That's for sure, but nowhere near 74.5.
I know this management, ODFL management, CEO Greg Gant, and the company continue to prove their abilities as a management team to operate the leanest and meanest LTL. I mean, here's some more data for you. The consolidated revenue only grew 1% year over year. Tonnage increased 1.3%, but yield dipped about 0.5% on lower fuel charges. But again, they think the OR improvement came from improved pricing, and they also were able to see declines in most expense lines, most notably compensation and operating supplies. So just incredible.
Yeah, no, they've been doing this since they were since inception, back during the Depression. They've been doing this type of thing. And talking to George Abernathy, our president, as you know, earlier about this particular article, it seems like every generation that's running it just gets better and better. And they surround themselves with really smart people. It's a very well-run company. There's no doubt about it. And they've been able to go through this when others were hurting because of the sudden change in the product mix, right? You got to look at your freight mix and freight volumes that are moving, and they've been able to navigate successfully, which really doesn't come as a surprise to me.
Yeah, I mean, another reason that Wall Street gives them such a big trading valuation over their competitors, over XPO and others. So another company here, we're going to jump to earnings on Covenant, Chattanooga-based Covenant. They saw a modest revenue growth of about 4.3% year over year in Q3, but they were able to squeeze a significant amount of profit from that rise. So total revenue, excluding fuel costs, rose 4.3% to $210 million, but excluding fuel, total revenue was down about $1 million. So most of their revenue here came from fuel surcharges. Operating income for the company turned around to a nearly $7 million profit from a loss of $3.1 million this time last year. And the adjusted OR, here we go. We can talk about ODFL here. The adjusted OR improved to 93.2. So they're probably popping champagne bottles at Covenant from that after being 101.6 this time last year.
Yeah, they dropped it rather dramatically, didn't they?
Huge drop.
Just under 8 points is a good drop. And they did all this through efficiency gains, correct? I mean, they removed a significant portion of their tractors.
15%.
Did they not? 15% of them, and focusing a little bit differently and running a little bit leaner, a little bit more efficient, going after the more profitable freight.
Yeah, I mean, the profitability performance is striking, really, in light of some other numbers here. So truckload revenue, excluding fuel, like I said, declined 11%. The expedited division saw revenue fall nearly 10%, as did the dedicated revenue. But Parker said that this was all kind of part of the company's strategic plan moving forward. The drop in revenue, he said, is consistent with their plan to refocus our asset-based fleet around dedicated and expedited operations while downsizing solo driver reefer and other less profitable operations. So yeah, like you said, efficiency driven. Wall Street really hasn't reacted well to the news, though.
Why do you think that is?
I don't know. I think, well, Seth and I are actually going to talk about this. We think that Wall Street is expecting this market to turn similar as it did to in 2018. They see those new truck orders coming in at 31,000 coming in above replacement rates, as with the new trailers. I think they're expecting capacity to be able to enter the market here in the first half of next year and seeing this market turn. So we think that trucking stocks might have peaked for now. We don't know if Wall Street's right on that, but tune in at 2 o'clock on Great Quarter Guys, and Seth and I are going to discuss that.
I got you.
In
So
detail.
you're thinking it's more of an industry-wide feeling of where
it is. It has been so far. I mean, the entire sector has traded off in the last couple of days, or the last couple of weeks, about 10-15%.
Makes sense. Makes sense. Makes sense. What else we got here?
All right, we got another one here. Two of the biggest names in trucking and autonomous vehicles announced a partnership on Tuesday, raising the stakes to get fully autonomous trucks on the road. In a virtual press conference, Daimler and Google-backed Waymo announced a collaboration to bring AVs to the market. Former CEO of Daimler Trucks North America, Martin Baum, said this is a historic moment when the best in trucking manufacturing OEM meets the best in software. But get this, Mike, this is pretty funny. Baum described the arrangement in a very German way. Baum is of German nationality. He said, so Waymo is not going to be paying, Daimler is not going to be paying Waymo for its technology. Rather, he said, you don't have to be married just to go to the cinema and watch a movie. They're working very closely, but there will be no equity exchange yet so far, which I thought was great.
It is, so it's a completely platonic relationship.
Yeah, exactly. And, we're still years away from this, right? So we're still many years away from level 4. Level 4 is where trucks, trucks can operate pretty much in every condition without a driver. This partnership, Waymo and Daimler, didn't lay out a timeline yet, but the competition is kind of aiming for 2024. That's when TuSimple and Navistar have said they're going to be aiming for a level 4 truck. And I just want to give reference here. So we wrote a paper, the Passport team, actually before it was named Passport, but Seth and I, we wrote a paper last year on autonomous vehicles, and he kind of laid out about a 10-year trajectory. He was thinking it would be late 2020s, early 2030s before we saw any kind of widespread use of these trucks. And the more and more data we get from this, the better and better we feel about that expectation. If we're level 4 in 2024 or 2025, really in our eyes, the only company that can bust this timeline wide open is possibly Tesla, but they're very secretive about their autonomous trucks, so who knows? But we're feeling good about our projections. It's still going to be many years before we see these things really at any scale.
I think you're right, but there'll be a rollout, don't you think? It'll hit specific sectors first.
Oh, certainly. I think drayage and small regional moves would make more sense. But
yeah, when you start in a more controlled environment, like inside a port or inside a railhead or that type of stuff, you could see it where the environment's predictable. There's less anomalous events that you need to be concerned with, right? And then you expand it out to, I think over the road really comes in. Long haul comes in before you get the mid haul and the short haul right into the city, which if it's more than driver assist would be interesting.
Yeah, I agree with you. I think long haul makes sense. That's why we've seen TuSimple running those straight routes from Arizona to Texas. Pretty much a straight flat road. I guess it's Highway 20.
Let me ask you this: when Baum says you don't have to marry just to go to the cinema and watch a movie, we are working very closely together. So they're not like working on building a Navistar today that they're going to roll out. They're looking at the technology and discussing different ways and kind of watching each other in a collaborative way to see where this might take it.
I think so. I think it's so much going to be that they're going to kind of share resources and share brains without actually buying into the company at all. There's going to be no equity exchange or no monetary exchange right now, just exchange of brains, which we'll see how it works out for them. I think that's going to be the best method moving forward on getting these big projects like drones and AVs to the market. I think it's going to be a partnership between an established OEM and an upstart like Waymo that's got the software, which I really think Baum's right there. This is a perfect match of some of the best OEM manufacturing and some of the best software. So it's going to be good.
I would agree with that. It seems like a very a conservative and prudent approach to this and going down this path in a very logical way. Which is the best that we can hope for, right?
That's right. So I think we got the weather up next with Mr. Nick Austin.
Oh, Mr. Nick Austin. Is he in studio now? Nick, we got some weather events going on, my friend. What's going on?
You bet. We have two major events. We got a winter storm in the plains, and it's actually the second round of snow and ice for some of these areas this week. And we have Tropical Storm Zeta, which is going to become a hurricane. It's going to hit the U.S. Gulf Coast, unfortunately, heading into tomorrow. So if you look in sonar critical events, we'll pop up the map. We have the radar up already. We have a huge area of snow from the southern Rockies all the way over to Missouri. And we also have some freezing rain. That's really going to be the big issue with this particular storm, especially from around Wichita Falls, Kansas, up to Oklahoma City metro area near Tulsa. That's where we're going to kind of see a strip of swath, if you will, of freezing rain. A lot of icy conditions, bridges, interstate overpasses. They've been really bad already the last couple of days. A lot of accidents reported by the state DOTs there, including tractor-trailer accidents. So truckers just need to be extra careful. It's probably going to be another 24 hours before this storm is faded and out of that region, and they'll get to thaw out later in the week. But you can see several airports and energy facilities here listed that are in the impact zone of this particular storm. So this one, it's a doozy, I would say, for this early in the season. So it's really going to cause problems, I-40, I-44 through that region. So, but let's move down into the Gulf of Mexico. Here's Tropical Storm Zeta, which is going to move further across the Gulf of Mexico. It's going to become a hurricane again later today, probably a Category 1 hurricane. It's going to hit the Louisiana coast probably Wednesday evening. So here's the main impact zone here for that across southeastern Louisiana over towards southern Mississippi, southern Alabama, tropical storm force winds all the way to Pensacola. So the hurricane force winds are really going to start affecting this area probably Wednesday afternoon, not long before landfall. There'll be storm surge, the usual flash flooding. But the good news about this storm is that it's not going to last a long time. There won't be major flooding. And there's not going to be a lot of major disruptions as far as freight flows. The problem is that this region has already been hit by hurricanes this season. And so it's going to really delay that rebuilding and recovery process with this storm coming in. This is the 11th hurricane of this season. It would be the 9th landfalling hurricane this season in the continental United States. Records we didn't want to see broken this year, but it's been one of those years as far as the hurricane season. So luckily, it's not going to stick around that region for several days. It's going to be a pretty quick mover, even after it makes landfall.
All right, Nick, thank you so much. Some nasty weather coming ahead in the plains. Thank you for that. We're going to have Nick back here at the end of the show to tease us a little bit about the 5 winter storm survival items every trucker should have, so stay tuned for that. Mike, we got some viewer comments?
Yeah, we do. So Dana Adams at CTB says, good morning, y'all. Nico Brown, hello, everybody. Hello to you guys. Rhonda Bembenza Zimmerman, hi, all. We've got Robert Scott at Materials Handle Operations at Verst Logistics. Hi, y'all. And Nico Brown says Skybit's tracking with cargo sensors will affect your operational profits. Okay. But then he follows up with saying technically any trailer tracking will help with those profits. But he's a little bit partial.
Just a bit. Just a bit. Well, it's good to see he's out there paying attention. Thanks for everybody for the comments.
Yeah,
I think we're going to have Zach Strickland up here in a few minutes to tell us what's going on in Sonar. You gonna have freight casting this week with the event coming up, or are we?
No, with the event we're not having it this week. So,
understood.
But yeah, we'll be back up again.
Okay.
No doubt.
Good to know.
Yeah, so we'll have him up there. So get your comments in. We are live active. I didn't say that beginning of the show, but I've been reaching back out to these people. So get them in, and we'll talk to you and get your comments and questions answered. And hopefully we'll go to Zach here in a second and talk about what's going on in the market. Zach, how you doing?
Hey there, guys. How are y'all doing?
Doing great.
Good. So the freight markets have been kind of on a little bumpy ride here since we started October. We fell down for the first couple of weeks. Tender rejection rates came down, but not dramatically. So now they started to come back up a little bit in the last week, and now they're falling back down slightly again. So it's really just hovering. We're really not having any dramatic shifts in the freight market overall. What is interesting, though, is that overall the trend is for volumes to remain relatively stable, whereas tender rejection rates are coming down further. So right now we're sitting at about a 24.76% tender rejection rate for the United States. And the volumes are actually right on par with where they were on October 8th, where we had a 26.5% tender rejection rate. So volumes remaining relatively strong, but tender rejection rates actually coming down. And the reason for that is simply we're seeing more freight moving into the East Coast right now via the imports and everything like that. We have tender rejection rates actually increasing out of Elizabeth, New Jersey, while they're falling out of Los Angeles, California.
So Zach, do you think this is more a case of just freight being repositioned? This isn't a case of maybe contracted freight being renegotiated up and we're seeing contracted rates inflecting upwards? This is just kind of repositioning?
Yeah, it's a little too early to think that this is going to be, repriced freight at this point in time. I think we're actually just seeing, carriers have obviously known all about Los Angeles for the last several months, so they're getting out there right now. There's probably a little bit of that mini bid or rollout influence where they've repriced some of this freight just to get it moving, especially as we near peak. Season coming up here in November and December. So these retailers know they need to get this freight into the consumption centers and ready to go if they want to capture that revenue. So yeah, there's probably a little bit of that influence, but at the same time, I think a lot of the shippers have also been repositioning this freight via maritime influence. So they're actually getting more freight coming in through the eastern ports right now, as we've seen East Coast port volumes increase at a much faster rate here over the last month or so compared to the Los Angeles ports.
Yeah, it's interesting, Zach, when you look at the outbound tender volumes or the load volumes by length of haul, we're seeing that same pattern where the long haul kind of rises, the tweener rises, and then it starts to drop a little bit, and you start to see the mid haul, the short haul, and the city start to tick up, which is actually happening right now, right? So you see that kind of repositioning that's going on there. You mentioned the maritime. How's that looking as far as more pressure on these volumes and capacity at the port cities?
Yeah, the maritime is not slowing by any means right now. It looks like it's going to remain very strong for the near future. We look at bookings here, and it's still outperforming year over year. Shippers are still bringing in a lot of freight into the market, so it's injecting it with the fuel that it needs to keep that capacity relatively tight. Even though I say that Los Angeles volumes are coming down, they're still historically high. We still see a lot of volume coming in through the ports of Los Angeles and Long Beach. More so through Los Angeles right now than Long Beach, but a lot of this freight takes a long time to get to those eastern ports, so there's still a lot of pressure on those western ports. And like I said, tender rejection rates dropping from 26.5% to 24.5% over the course of 3 weeks is not a dramatic shift in the freight market overall. You're going to see some relief pressure, on spot rates to an extent, but it's just a slight incremental decline in overall volumes. And then again, we get into November when a lot of the retail peak starts to hit, that e-commerce really starts to flow. Amazon Prime Day was just a few weeks ago. We still have to see, we have yet to see the enormous amount of pressure that is going to bring to the freight market here in November and December.
Very interesting. So, when you're talking about the ocean and so on, I'm looking at our ocean shipments here, and the 7 day out, the shipment index is at a 142.99 versus last year at this time when it was at a 94.75, and the number of TEUs you're looking at a 216.90 versus an 83, and these are the bookings. These aren't the imports. So this is stuff that hasn't even been stuffed in containers yet. These are the bookings. So that pressure seems to be pretty good. What about the volatility in the market? I know that volatility has kind of almost seemed like it's a little bit into a normal. Are we seeing major volatility in the major markets, or is it kind of more in the mid markets?
No, we're actually seeing more volatility in the smaller markets right now. Kansas City, for instance, again, kind of on that, it's kind of unique in the way that it's been on this borderline of this weather system where we've had a lot of snow and rain back and forth. So it's kind of reflected in the freight market that way, with tender rejection rates going super high one day and then coming back down the next day. Very volatile sector there in the middle of the country. The midsection of the country has really been one of the more hit or miss markets or regions of the country since all this, import fluctuations, and obviously the volumes on the west and east coasts moving back and forth as carriers are trying to get into Los Angeles, accepting more freight to get them out there. There's just not enough freight moving out west to really maintain the balance there. So, you know, a lot of these smaller markets throughout the midsection of the country have been neglected, and they get exposed quite a bit when you see a lot of this long haul freight moving from east to west, or west to east, I should say. But Memphis right now, one of the strongest or the biggest markets in decline right now in terms of overall tender rejection rate, indicating that capacity is really prevalent in that market right now. A lot of volume coming out of Memphis as well, but so the midsection of the country has really taken over in terms of being those hot and cold markets. You know, and it is kind of ironic considering that the weather, we're changing seasons as well. So it's almost like they're moving in tandem with each other, as a lot of these temperature swings are also influencing the freight market.
All right. Thank you so much, Zach, the Sultan of Sonar, Director of Freight Intelligence here. So much going on right now in the markets.
Yeah,
I mean, on
really
everywhere you go. I mean, we're, you know, like you said earlier, that there hasn't been much volatility over the last couple of weeks. It's just chaos has become the new normal, you know?
Yeah, I mean, that's why I asked him. It kind of seems that way, right?
Like
when
we've become so
looking at
accustomed to 25 OTRI.
You do, because you're watching the markets and you see like Dallas is just kind of there, and then all of a sudden it's got strong increases or changes in the head haul market, which can just come up and bite you, right? If you don't have that data and you're not trending that data, you're not going to know that that's going to happen. You kind of get lulled into this false sense of things are starting to calm down a little bit. Not so. It's crazy out there. It's absolutely crazy
Certainly
out there.
not. We have our lead economist, Anthony Smith, coming up. He's going to talk a little bit of durable goods. We just had a blowout number come out this morning and his GDP expectations. Anthony, what happened, man? We saw durable goods come out higher than expectations. What drove it?
That's right. So we saw a 1.9% increase for durable goods. So this is something that exceeded a lot of people's expectations. A lot of it came from, of course, when we're looking at some motor airlines did a little bit better than expected. But overall, we are exceeding pre-pandemic levels. So this is a good sign. The other thing to be mindful of is like a lot of people are looking at this as maybe a precursor of a stronger manufacturing trend as we close out the remainder of the year. But to keep in mind is that when we look at year-over-year trends, we did see a bit of an uptick this time in 2019 towards the end of the year. So we're going to have some harder comps coming up for year end for the industrial sector. But overall, we're seeing some signs of improvement. So fifth straight month that we saw durable goods move up. And when we look at core capital goods, looking at more so business to business investments, I believe this was the second consecutive month of increase. And so we're seeing some substantial rise. Again, industrial sectors were in a weakened spot before the pandemic, so it didn't take too much for it to kind of precede pandemic levels, but a good sign overall. Again, this is going to be something that's region by region, and when we look at overall orders, it's going to be played by subsector. So a sign of good news, of course, we're seeing some more business investment coming in. So of course, this is good news for freight volumes. We're looking at both flatbed and dry van.
So Anthony, I think I saw that the auto sector did really well. It was something like 1.1% or up over the last month. Can you speak a little bit to how it differed by sector? I know auto did well. How did the other industrial sectors fare?
Definitely. So when we're looking at different subsectors, you just hit it right there. Auto was a really good subsector over the last report for September. And when we're looking at that, that's really going to be telling for how close to the consumer is going to be each subsector is impacted by. So auto is going to be a little bit closer to the consumer, a little bit further downstream compared to something like machinery, which is a little bit more upstream. Machinery did not fare as well in this latest report, but we are seeing positivity overall. But we can expect the closer, further down to the consumer, the better it will likely be. Also, when we're looking at overall new orders, there's going to be substantial backlogs, of course, when we look at limited capacity to produce certain goods. We're looking at appliances, washing machines, dryers. These things were from correspondence reports from previous reports. We saw that they were on backlogs. And so there is still going to be, I think, a lot of momentum for certain consumer durable goods. Of course, durable goods being things that have a shelf life of 3 years or more in the coming months here. But when we're looking at closer to the consumers, a lot more strength there as opposed to further upstream. We're looking at manufacturing for machinery and certain parts like that. We also saw some weakness this time around for electronics, so that was a bit of a surprise and a bit of an exception. But overall, we are seeing some positive growth overall.
All right, Anthony, we know that the consumer is doing fairly well. It's faring okay given the economic backdrop in the country. People are kind of calling this 30% GDP number. This seems to be the number that I keep reading for Q3, and this is after we fell 31.2 or 31.9% in Q2. Are you expecting that 30% number? Do you think we get there? And where does that put us on track for year end? Will we still have a smaller economy at the end of the year if we have that 30% growth rate in Q3?
Definitely. So just right there, we are expecting, I'm expecting a pretty substantial rise. I don't think 30% is out of the question at all. When we're looking at last quarter's report, we did see a substantial decline, of course, I think it was 31.9% or somewhere in that area. So I do believe we'll be able to notch just over that 30% and even potentially get above that 33%. I mean, that would be, I think, on the higher end to show some growth overall. I think it's going to be leveled out a little bit more so in the fourth quarter, of course, depending on the trajectory of the virus and the cases, because we are seeing many states that have increased single-day numbers. And so, of course, the virus is going to dictate overall growth as we get throughout the end of the year. But I am expecting steady rise into the fourth quarter. I don't think 30% is out of the question overall when we're looking at what's happened over the last few months, where we've had substantial fiscal support for many consumers throughout that time frame. Although we did have expiration of those bonus benefits, we did have substantial consumer spending overall. And as we know, that's going to be the main driver for overall GDP. And again, I think when we're looking at GDP, this is a good reminder that GDP is not the end-all be-all for overall economic growth. I mean, throughout this entire time, even before the pandemic, we were looking at a goods-adjusted GDP, looking at what impacts freight and what does not impact freight. And is GDP really telling for what the overall U.S. economy is feeling right now? Over the last quarter, or the previous quarter, of course, we're throughout the pandemic, but we did see significant spending from the consumer. So although GDP is a good barometer for the overall production of the country, it's not the telltale sign for whether or not we are in substantial health, especially when we're looking at the overall freight industry. That's really where we're looking at the goods-adjusted GDP and other things that might be more telling for industry growth instead of the overall GDP number.
Excellent stuff. Thank you so much, Anthony. Wow, some really, some actually very encouraging stuff. And Anthony going out on a limb saying, "Hey, 30% is not out of the question."
He's going even further, saying he thinks that we can even erase the decline in Q2, which would be incredible.
That'd be incredible. I mean, think back to Q2, beginning of it, when we were to what we were talking about, right?
Yeah, I mean, it was terrible. I remember March, we would sit out here and count the cars that went by. There was one every few hours. I mean, there was no economic activity at all.
You'd count them all day long on one hand.
It was nuts.
Hit single digits today. Yeah, really good stuff. Thank you, Anthony, for that stuff. So we have our first guest, Chris Richter, who is founder and CEO at FloorFound, with us. Chris, how are you doing today, sir?
Hey, Michael. Good to see you. I'm doing well. It's a little chilly in Austin, Texas today. It's rainy and in the 50s, so that's cold for us in Texas.
Wow, you have to come over here to sunny Chattanooga, where it's about the same. Actually.
So great. It's great to be here. Thanks for having me.
Yeah, absolutely. So, Chris, a little bit about yourself and a little bit about FloorFound for our audience, please.
Sure. So my background, I've been in technology in the Austin, Texas area since about 1996, so a very long time. Have been involved with multiple successful startup technology companies in the Austin environment. I spent the last 5 years as the head of revenue for a company called Convey that was heavily focused on assuring that the last mile delivery experience to the consumer was improved, meaning both speed, cost, and service level. Really, we used to say, both enable retail brands to make better promises to the consumer and then keep the promises that they make. So the last 5 years of my life was spent focused on that. The previous, 12 or so was spent in the e-commerce space. So I would say FloorFound kind of emerged from those combined experiences of a lot of time spent with retail e-commerce teams, and then the last 5 years drinking from the fire hose of last mile delivery and all of the challenges associated with that, including the challenge of oversized reverse logistics or oversized returns.
Yeah, which is what FloorFound is in that space. So let's talk to that a little bit because things have changed. Was it changing before the pandemic to this type of situation where you've got these oversized being delivered directly to the homes, or has that really increased because of the pandemic?
So a few things have changed. Certainly over the last 5 years, supply chain and logistics has become the bright, shiny, or sexy object that it wasn't necessarily 5 years ago, as retailers are aware that consumers' demands for the delivery experience only continue to increase. And so I think the big change as a result of COVID is in the categories we're operating in, which are the larger item categories like furniture, large electronics, home fitness, et cetera. You've seen accelerated adoption of online for those categories. Some folks have said 2 years accelerated adoption, some have said 5, but the reality is that even at 15% e-commerce penetration, these oversized categories are still nowhere near the 30% penetration of e-commerce that you see in categories like apparel. So I think that's set to change pretty dramatically over the next few years, and the reality is that retailers are still working on how do we get it right on the outbound journey. The reverse journey hasn't really been addressed in the way it needs to be. And so I think we've only, taken and put a bigger spotlight on the problem. And the challenge, as you all know, is with inventories being tight, importing being tough, retailers are trying to keep up with the inventory requirements to meet the sales plans that no one knew what was going to happen in March, but all of a sudden everyone's exceeding their sales plans. So where does the inventory come from? And we happen to believe, open items that are like new returns are a really great source of inventory for the consumer out there who's anxious to be able to lean in on sustainable brands. So that's kind of what's changed, I would say, with COVID.
So, Chris, we recently did, me and the research team, we recently did a last mile survey of consumers. It was one of our first consumer-facing surveys, and some great numbers. I'm sure that you would speak to these numbers and say that they were true or not. So we asked them when was the last time they had something delivered inside their home, so got this type of white glove delivery. Almost 60% said they'd had something delivered in the past 30 days. And then when we asked them what kind of product they had purchased, 60% had said furniture. So this is definitely something that I'm sure that Chris can speak to how kind of the increase in demand that they've had. But what does the increase in demand look like on the reverse side? Have you seen, as people have bought more furniture and more things to be in their own home, has this increased or decreased the amount of returns that you guys have had since March?
Oh, I mean, we're definitely seeing increases. And, I think it's a bit of an arms race in terms of, who can introduce what type of return policy do you need to offer to be competitive, and who can introduce the most liberal one? So, we have a brand that we work with that offers a 365-day, no questions asked, no restocking fee return policy, right? So I think two things are happening. Number one, there's just growth in the category, so more returns resulting from that. I think number two, brands feel compelled to be more and more aggressive from a competitive point of view in terms of offering free returns. No question asked, buyer's remorse, free returns. And so the volumes are definitely increasing, but the solution in terms of what to do with those volumes hasn't been introduced. And so, what we really think a lot about is what is the impact of this just from a sustainability point of view? And, this is a little bit of a dated number. You can imagine what it is today. But, in 2015, the EPA identified that there was about 10 million tons of furniture that goes into landfills. And so it's a brewing, environmental catastrophe, and it needs to be addressed.
So Chris, I have to think when you mention some of those brands that are aggressive in their return policies, the one that comes to mind are the Casper or the mattress in a box guys that say that you can use this for 90 days or whatever. We'll pick it up no matter what. That seems to be the type of brands that are establishing that as kind of the norm. Do you think that they have the power to make that a norm across the industry, similar to what Amazon has made 2-day shipping, or is this something that only those kind of mattress in a box retailers will have?
Yeah, it's funny you mentioned that because I just spoke with one of those right before this call. So, I think, it's like free fast or free same-day shipping, the race to the bottom is just unsustainable, right? I mean, those are marketing programs. Those aren't sustainable policies, right? So the reality is that those programs are not working that well for those brands. They're huge loss centers for those businesses. So I think they have to figure it out. And, what we're trying to figure out is how do you, turn the tide in terms of making the idea of an oversized threshold two-person return pickup a viable economic argument for these retailers so that they can stop making the decision to field and destroy as many items as they are and start making it more viable to salvage these items and in fact offer them to the massive, purpose-driven consumer audience that is out there for them. I think mattress is a little bit, more challenging in ways than furniture. The qualities that furniture has, of course, is that furniture is durable. It's not as sort of seasonally tied in terms of fashion trends. And so, there is a good resale market for furniture. The challenge with mattresses, of course, is, there's a higher degree of sanitation required to make a mattress resellable. And there are, in fact, state-specific regulations and requirements around what do you have to do to be able to resell a mattress. So I think the overhead's a little higher for those kind of brands. But I can say for sure that they've set the tone for what other brands now feel like they need to be doing in terms of return policies.
Excellent stuff. Thank you so much. Go ahead.
Hasn't kept up with marketing. Yep, go ahead.
No, I was just going to say, hey, we're out of time on this segment, Chris, but thank you so much for that. It was excellent and very insightful. Where do people go to learn a little bit more about FloorFound and find out what you guys are doing there and find out your services? Yeah,
absolutely. So FloorFound.com. There's a lot of information there about not only what we're doing, but also, we're trying to provide more and more information, education about why this matters from a sustainability point of view. So yeah, FloorFound.com, and we'd love to engage with any brands that want to learn more.
Excellent. Thank you so much, Chris. Have a great day.
Thank you. Okay, take care. Thanks for having me.
So it's interesting because you talk about the mattress companies kind of bringing this to light, right? But I mean, when we talked about the reverse logistics and what's going on there, we've talked about the returns is exponentially higher on e-commerce than it is from going to a brick and mortar. And I would guess that these companies that are dealing with these more there's more of a vested interest from the purchaser when you're talking about a larger item, furniture that you're planning on having in your house for more than a year and then throw it away because it's worn out type of thing, right? And appliances, the more durable the goods, you've got to entice them to be comfortable with purchasing that online, and if they don't like it, being able to return it, right? I mean, there's the pressure from the consumer to get them to buy your stuff, right?
Yeah, I think you see the two industries that I see the biggest theme of this happening here is cars and mattresses. Cars are a big one too. You've seen the percentage of cars being bought online since 2000 has grown exponentially. It's grown from roughly 4 or 5% to now almost a quarter of the cars are bought online, which is nuts. And I still don't know if I would buy a car online. Yeah. I still want to get in it. But now you go to Carvana and they give you 7 or 14-day free return. You drive it for 14 days. If you don't like it, they'll come pick it up for free. No strings attached. So I think that will eventually become the norm. They're just going to eat costs until they get to that point, like Amazon did, until they get market share and then lever up and hopefully make some money on that down the road. But we got our second guest ready to go. We got Laurence Alvarado, co-founder and CEO of WARECAP. Laurence, how are you?
Good. How are you guys?
We are lovely. Thank you for joining us. So we're going to talk a little bit about warehousing, but before we get into that, so tell us a little bit about WARECAP and a little bit about yourself to get the audience understanding what we're going to talk about.
Yeah, absolutely. So it's good to be back. So WARECAP.com, we are essentially the Airbnb of industrial real estate. So we do the short-term and fractionalization of any type of industrial real estate, warehousing, freezer cooler space, parking lots, rack space, yard space, those types of things. So we'll work on the demand and also on the supply side. We just match it up and let it go. So that's what we do.
Well, Laurence, that's actually a great way to describe. I'm glad you give the Airbnb reference.
Yeah.
That helps a lot of people in the audience, I'm sure, understand what you guys do. That certainly helped me. So let's talk about the current state of warehousing. We know that e-commerce is being driven higher right now. Warehousing employment is now 3% higher than it was at pre-pandemic highs. That's after plummeting 8% in April. So tell us right now, what's going on in warehousing, or is your demand as high as the warehousing employment is?
Yeah, it absolutely is. And we're actually seeing surges in some of the other areas. So a huge surge in parking lots, for example. So trailer drops, being able to go ahead and stage different types of things. And of course, one can certainly not ignore the whole reefer, freezer cooler space. That is attracting so much interest, as I'm sure you guys can attest. I mean, it's not cars or mattresses, but there's a heck of a lot of perishable things that are going through the supply chain right now. So those are the big things we're seeing.
Yeah, absolutely. So when you're talking about, you described it as Airbnb, as Andrew pointed out, you're in the flex space. Has the terms of those changed? Are you seeing any longer term asks from looking at this flex space in the warehousing or in the reefer warehousing?
Well, not so much. We would think, a lot of it depends on the tenant, and it also, of course, it depends on the type of, the location. Where we are seeing an awful lot of increase is in a huge trend, and I'm sure you're seeing it as well, but the whole retail to industrial, or RTI, we're seeing an awful lot of that, especially within the micro warehouses. So we're seeing people that are looking at, that cannot find the large space or even the flex space or fractional space within a large warehouse. So then what they're doing is looking at these sub-optimized strip centers or other type of retail areas, and we can bring in software and create a certain amount of micro warehouse that really facilitates a pick and pack type of operation, and also a last mile fulfillment. Where we are seeing the kind of longer areas are actually oriented around disaster relief. So we've had a lot of demand, and especially filling in like in Iowa or hurricanes or those types of things. People want to be there to go ahead and pre-position a lot of their reconstruction efforts and disaster recovery efforts, and of course that demand is going to be for everywhere. That's just a matter of availability based upon what a disaster has left. But that's kind of where we're seeing some of the major trends.
Well, that makes sense. We just heard Nick Austin earlier at the top of the show make a reference to the record-breaking 9 landfall hurricanes so far this year.
Yeah.
Going to have more moving forward, unfortunately. But let's talk a little bit about that cold storage. You mentioned it earlier. We know that there's going to be a vaccine within the next year that's going to have to be distributed and moved along. What are you seeing in terms of the vaccine? Are people going ahead and buying up space? What are you seeing?
So we don't see a lot of, relative to the vaccine, we see a lot of interest in terms of very, very sophisticated supply chains, but it's what we really are seeing at the moment is on the key trends in terms of food, mostly on that. So, probably you guys, maybe not, but I know a lot of folks that have done the meal kits and the farm to fork type of thing, and just all of this kind of, rush towards the organic, and people are, they're getting out to the grocery stores. But, you guys mentioned it even with your last guest, that there are lots of reasons not to go anywhere, and things are going to come to you. So we see an awful lot of last mile importance. We see, just the input of reshoring and onshoring, and that whole kind of farm to table, farm supply chain is really driving a huge amount of cold storage vis-a-vis Kroger, vis-a-vis some of these other very large, H-E-B, very large grocery chains. The vaccine requires very specific types of temperature, but quite frankly, you're dealing with a lot different footprint than you are dealing with, several thousand heads of cabbage, as an example.
Yeah, you definitely are, and you don't know exactly what those requirements are going to be for the different vaccines, right? Some are -8 Celsius, some are deep frozen, like -90, -94 degrees Celsius. When we spoke earlier in the year, there was a lot of fractioning or the fracturing of the different markets within the United States, right? We saw the disruption of the different goods going. Are you seeing that again now as we see some upticks in some of the cases, or are things kind of relatively smoothed out a little bit?
Well, what we're seeing, I would say that there's I wouldn't necessarily see a fracturing as much as I see a lot more creativity, a greater propensity for partnering, and also a greater propensity to go ahead and look at the automation of certain types of things. So there's been an acceleration within, for example, robotics, the application of automated artificial intelligence to look at creating different, far better cost takeout initiatives in terms of the last mile fulfillment, and certainly within the creating partnerships to even create the goods that go into a last mile fulfillment. We didn't necessarily see that before. So within the last 6 or 7 months, think about some of these different investments that have been going on. Think about some of the partnerships that have been going on. You never would have seen it. I mean, you never would have seen, for example, this huge trend into the RTI space, the retail to industrial space. You never would have seen the trends between groceries really getting embedded into the artificial intelligence relative to last mile fulfillment, relative to Instacarts. Things that would be considered as competitors before are now bedfellows, and so it's not necessarily the fracturing, but almost the unification in many respects.
Yeah, Laurence, you're exactly right. As soon as you mentioned the creativity, I thought first to Target owned Shipt and their recent partnership with Bed Bath & Beyond to deliver last mile stuff out of their stores, which I think is so good. So I gotta wrap us up here, Laurence. But thank you so much. Give everybody in the audience just a shout out. Tell us where they can find more information about you and about your company, man.
Absolutely. So WARECAP.com, you can have a whole host of information. You can find us on LinkedIn as well, but WARECAP.com is the best place to find us.
All right. Lovely, Laurence. Thank you, man. You have a great rest of your week.
Thanks, Laurence.
Thanks, guys. Take care.
Man, speaking of the rest of the week, we have a big week ahead of us over the course of the next few days here at FreightWaves. I got a whole 3-day summit coming up next week, virtual summit.
Yeah, we definitely do. So what is it, on Wednesday, right? Which would be
kicks off the 4th.
We kick off with Freight Tech Venture, right? Which is going to be pretty cool. The Freight Tech Venture Summit is where we're going to dive deep into the various sectors of transportation, rail, truckload, LTL, warehousing, and more, and seek to connect the forward thinkers and innovators with capital-intense investors. This is going to be quite exciting to see these different things, right? And who knows, man? You get involved there, you may have some deals being inked.
Yeah, I definitely think there's the propensity for that. I mean, we've got a huge keynote as well. Steve Case, the former co-founder of AOL, now involved with venture capital very heavily. He's going to be the keynote. We've also got Brian. Do you know Brian's last name? Because I know I'm going to butcher it. Aoi. Yes. Brian Aoi from Refashion Ventures. I'm actually going to have Great Quarter Guys. Me and Kevin Hill, after he's going to be back from holiday. Me and Kevin are going to have a live Great Quarter Guys with Thiago Olsen, who is the managing director of Engage, which is a venture fund group and a growth program that has established partnerships with some of the biggest brands in the world, such as AT&T, Chick-fil-A, Delta Airlines, Goldman Sachs, Home Depot, UPS. It's going to be incredible.
Anyways, Thiago Olsen, I'll be watching that for sure.
Yes, he's going to be a smart guy.
Been a good friend of mine for the last 4 years.
And then just after that, so we got the one-day venture summit, and then we've got the 2-day our once a year at home live in the fall.
At home live fall event is going to be tremendous, right? And we got Craig Fuller, who's going to be discussing with Waymo.
Right. So we were just talking about how the partnership with Waymo and Daimler. Yeah. I'm sure that this guy John Verdon, who was head of partnerships and business development there at Waymo, I'm sure that he's going to talk about that with Craig, and they're going to talk about how they're going to commercialize these autonomous vehicles moving forward. So I'm really excited about that. That's going to be one of the best discussions of the entire event, I think.
It really is going to be a good one, and some of the other ones that I'm interested in hearing too is Peter Harris from UPS talking about urban logistics and delivery. There's so much in there, especially with the new technologies, right? Getting into that urban setting, as we talked before, with autonomous, Waymo, et cetera, getting through those different, there's some different challenges in those areas for some of the technology that's coming into there. And also the post-pandemic supply chain with Willie Shee from the Harvard Business School will be interesting. That's something that everybody's talking about. In our last summit, There was a quote there that if your supply chain is the same as it was before the pandemic, then it's probably wrong.
Yeah, no doubt. Everything's changed since then, which is actually something I wish we would have had a few more minutes there with our last guest, because I wanted to ask him how he expected the flex warehousing space to be, once we have a vaccine. Do they, when e-commerce kind of comes back to normal, e-commerce has been pulled forward 2 to 5 years, but you have to think when the world is available to us and we can go out shopping, you have to think people are going to go back and shop, Oh,
there's definitely going to be some pressure to go shop. It's at what level, right? Do you need these big footprint retail, big box stores type of things, or do you need the smaller kind of like, Best Buy started making this move a while back. If you remember the old Best Buys, they were huge warehouse type of things, and then they made them more a little bit touchy-feely and go buy it on our website type of thing, right? And I think that gravitation is still to come as well.
Yeah, it's crazy. You see the complete opposite strategy from some of the biggest people in the biz. You got Walmart and Target that are doubling down on in-store sales that are offering both in-store and online, but they're using their only advantage over Amazon is their footprint, is their brick and mortar stores. So they're trying to use that against them. But we're gonna discuss all that. We're also again, this is a free event, the FreightWaves live event, as are all of our events. So you can go register right now for free at live.freightwaves.com. What did you guys talk about on What the Truck yesterday?
Oh, yesterday, What the Truck was a little bit crazy, right? So, favorite candies, right? By state, we went through for your Halloween candies, but
I saw Tennessee's was candy corn.
Bro.
My God.
It's crazy. But we were talking about, is now the time to sell your truck? We were talking about in the Canadian market, is that there's a lot of companies that are out there on the chopping block right now. Or, they're up for sale right now. Why would that be when things are so great? But are they looking forward and this is the best valuation we're going to get, and kind of testing those waters to try and jump in there? The verdict on the embezzlement bust that happened, and, the state of air freight, and we did some Wheel of Stupid, my friend.
Yeah, the Wheel of Stupid questions. I've got to get tuned in for that one time with you guys.
Yeah, and then the laser. Did you catch the lasers and the LiDAR that they're using in Georgia to specifically look for and bust tail? They're testing it to bust to look at tailgating from Class 8 trucks and so on.
No way. No, I didn't see that.
It was pretty interesting. The screenshot there, they can get down there and tell you like 0.3 feet away or 0.3 from it. But what it doesn't do is tell the story of how long was he there, that a car cut him off, that type of stuff, right? So we talked about those.
Never the full picture.
Yeah.
So let's get back to Nick Austin for the full picture on weather. We got a few more minutes for you. Nick, tell us a little bit about the 5 tools that everybody needs to have in their toolbox during bad weather.
Yeah, there might be a few that drivers out there maybe hadn't thought about, especially drivers who are just getting started out in the business, maybe truckers out there who haven't had to ever drive through winter storms, but may have to this season. So I don't want to give it all away, but kitty litter, believe it or not, could be something that they should keep with them, that it could help with traction, keep them from getting stuck in snow. There's more details about that in the article on our website, freightwaves.com. Cash. Always want to have emergency cash with you. Winter storms, whether it's ice storms or snowstorms, the power can go out. It does a lot of times during those storms. So truck stops, a lot of other places might not be able to do transactions with plastic. You're going to have to keep emergency cash on you. So, but there are several others that are in the article. Again, some of them may be a little lesser known. So I think there's some good information in there. So go check that out.
All right, Nick. Thank you so much, man.
Thanks, Nick.
All right.
Yeah, we used to use kitty litter. We used kitty litter, sand, that type of stuff.
For what?
For traction.
Oh. Did you drive a truck at some point?
No, but I grew up in the snow belt.
Oh, right, you're Ohio.
So to drive your car.
I'm born and bred in the South. I've seen snow probably 10 times in my life.
Yeah. Here's the thing: when it gets cold enough, salt doesn't melt the ice.
Really?
Yeah. No.
Wow.
It doesn't work so well.
Where I'm from, they always just throw the salt, and then there's never any ice.
just throw it around, cancel school, and everybody goes out and plays all day.
Precisely. Playing football in 50-degree weather on a snow day. It's nuts. All right, so like I said, Seth Holm and I are going to be coming up at 2 p.m. Stay tuned for Great Quarter, guys. We're going to have a very fun show. Seth just recently did a paper on driver wages, so kind of the inflection point. We're seeing this inflationary cycle. We just saw Schneider raise their driver wages 4% or 4 cents for experienced drivers, 2 cents for non-experienced drivers. So we're going to walk through his model, talk about what it means. Should you be increasing wages moving into 2021? Let's say the market turns. What is that going to mean for you in a softer market in 2022? If anybody hasn't read that paper, it is available to both Sonar subscribers as well as Passport users. And if you if you really want some of our research, go to Passport, go to freightwaves.com/passport. That paper, as well as all the stuff that JP's team puts out, is there.
Yeah, absolutely. I mean, that's the driver wages is intriguing to me. Is the war started? Is there going to be a war? Did you sit tight and?
Well, we think there's going to be a bit of a prisoner's dilemma. They're going to have to raise wages because everybody else is going to be willing to do so. And if they don't, they're going to lose their good drivers.
Yeah.
They're going to have everything go by the wayside. So I think that we are going to see this inflationary pressure. Maybe we see wages jump 10%. That's kind of what Schneider was pushing towards.
You don't see a wage war though, type of thing.
Well,
I mean, like 218, that type of thing.
You know, well, it may be because people do believe, there's a lot of analysts and a lot of industry execs that believe this bull market has more legs than the 2018 one did. So we could see that. Most certainly. But we're also going to get into kind of Q4 shipper outlook, as well as and how that and how the driver wages is playing into the trucking stocks and playing into capacity moving forward. We're going to talk about the bottlenecks at the driver training schools as well. Maybe that's pushing rates higher, but it's going to be really fun.
Yeah, well, I would imagine that analysts are looking at that as well. If they're thinking that things are going to soften a little bit or could soften a little bit, and like we saw that drag on Covenant, if they see that and wages going up, that's a further drag on their revenues and coming into the future.
Yeah, the basic model that he put was if driver wages go up 10%, as do rates per mile, and then the driver wages stick in 2022, and the wages stick and the rates don't, you see operating ratios going back up higher than they were in 2020. So it's going to be interesting. But thank you everyone for your time today. I hope you guys have a great rest of your week. It's been great, Andrew, Michael. I'll see you guys. Do your thing.
Peace and love.